40 small banks in China have disappeared within a week due to acquisitions by larger banks or declarations of dissolution. This may seem like a common big fish eats little fish scenario in the business world, but digging deeper, one can see that the health of China's financial sector is currently in an alarming state. Numerous storms have swept through the country's financial and banking market. The four largest banks in China, Industrial and Commercial Bank of China, ICBC, China Construction Bank, CCB, Agricultural Bank of China, ABC, and Bank of China, BOC, have simultaneously reported a surge in non-performing loans, NPLs, reaching 1.23 trillion yuan, equivalent to $170 billion, an increase of 10% compared to last year. Among them, NPLs related to real estate stand at 183.8 billion yuan, up 3 billion yuan from a year ago. China Construction Bank is facing the risk of explosion after reporting a 43.3% increase in NPLs, while the other three major banks saw increases in NPLs ranging from 1.25% to 12%. Zhongrong Dingxin is a giant in China's shadow banking industry, valued at $3 trillion, equivalent to the size of France's economy. This bank has also filed for bankruptcy, as it could not cover its maturing debts, and its assets were insufficient to pay off its liabilities. China's real estate sector has been mired in crisis since 2021, and now it is spreading to the country's major banks. So how should the banking sector of the world's second-largest economy weather this storm? Welcome to V-Finance Insights, exploring the impact on the Chinese economy. Up to 40 banks have declared bankruptcy, but experts believe that given the current volatile market situation, this number is likely to rise. As banks fall into dangerous situations, even dissolution, the state bank has to bear the liquidity burden from these banks, so corporate lending policies will also be tightened. This means businesses will find it harder to access capital because, simply put, banks will be more cautious in approving loans, borrowing conditions will become stricter, require more collateral, and interest rates will tend to rise. This tightening has made the domestic investment market gloomier. Businesses, especially small and medium-sized enterprises, often rely on loans to maintain operations and expand production. When they cannot access capital, many businesses will be forced to delay or cut investment plans, leading to a slowdown in business operations. As a result, investor confidence and the business environment will also decline, creating a vicious cycle that is difficult to break in a short period. All these factors have contributed to a slowdown in China's economic growth. When investment decreases, production will inevitably be affected, leading to increased unemployment and reduced consumption. This not only affects businesses, but also directly impacts people's lives and causes many social consequences. Not only limited to the investment sector, the rapid collapse of 40 Chinese banks has also severely damaged the trust of Chinese people in their banking system. The collapse of many banks has created an investment-averse mindset in the community, making people more cautious about using capital. They are concerned about the safety of their assets, leading to delays in investment decisions. Confidence in the banking system has also eroded, causing many to doubt the safety of their deposits and choose other forms of asset storage, such as investing in gold. This has led to a reluctance to save, causing a decline in deposits. When deposits decrease, the liquidity of banks is affected, and when there is insufficient capital, banks will continue to face difficulties in lending, exacerbating the economic hardships. In summary, investment aversion and loss of trust in banks not only impact individuals, but also have far-reaching effects on the capital chain and the development of the entire economy. The event of 40 Chinese banks collapsing en masse is not just a temporary shock, but could cause long-term fluctuations in the economy. To recover, urgent and effective measures are needed from the Chinese government and state banks to restore public and business confidence and create a favorable investment environment in the future. However, the shock of 40 small banks disappearing has not yet subsided when another storm hit. Zhongrong Dingxin is a giant in China's shadow banking industry, valued at $3 trillion, equivalent to the size of France's economy. This bank has filed for bankruptcy protection to liquidate assets after failing to cover its maturing debts, and its assets were insufficient to pay off liabilities. In the context of the ongoing real estate crisis in the world's second-largest economy before defaulting, Zhongrong Dingxin had engaged in many real estate sectors despite the industry's instability. Zhongrong Dingxin even raised capital from investors to lend again, including many real estate businesses. Shadow banks like Zhongrong Dingxin often attract public deposits and then provide loans and invest in real estate, stocks, bonds, or commodities. In recent years, while Zhongrong Dingxin's competitors cut risks due to concerns about the real estate bubble, the company, along with its subsidiaries, continued to provide loans to struggling real estate businesses, then acquired assets from companies like China Evergrande Group, the real estate giant that went bankrupt and is facing the risk of dissolution. The bleak end for Zhongrong Dingxin has raised concerns that China's real estate crisis could spread to the financial sector. More than 3/4 of the money investors put into Zhongrong Dingxin will never be recovered. Only about 100 billion yuan in assets, equivalent to about $14 billion, out of a total debt of 460 billion yuan, is likely to be recovered. Shadow bank-like asset management companies in China like Zhongrong Dingxin operate under much looser supervision compared to commercial banks. This case is a wake-up call for wealthy Chinese investors looking for high returns from investment products offered by loosely regulated financial institutions like Zhongrong Dingxin. The remaining 200 billion yuan in assets of Zhongrong Dingxin, if sold, could only yield a maximum of about 100 billion yuan to pay investors. Thus, investors can only recover about 23% of the money invested in the company based on the average total debt of 420 to 460 billion yuan announced by Zhongrong Dingxin. The actual recovery rate could be much lower. To find the root cause of the crisis, one must first understand that these 40 banks are among 3,800 other small banks scattered across China's rural areas. Although they are small-scale banks, the total assets of all these banks are valued at $7.5 trillion, accounting for 13% of China's entire banking system. Therefore, when this event erupted, it caused many Chinese people to feel insecure about the national banking system. China's real estate sector, with its extremely high financial leverage, has been in a liquidity crisis since 2020. Chinese real estate enterprise defaults since 2021 have hindered the country's economic growth, and the main source of this crisis also stems from a significant increase in bad debts, especially in the real estate sector. Many banks like Zhongrong Dingxin have persisted in investing in unviable projects. Some small banks have even revealed that their books contain up to 40% bad debts. Moreover, poor financial management and lax risk control have led to instability in bank operations. This event not only affects lenders but also creates a wave of panic in the financial market. People began to withdraw money en masse, leading to severe liquidity loss. The Chinese government had to urgently intervene, establishing a bailout fund and deploying restructuring measures to stabilize the banking system. China's major banks are primarily state-owned, allowing the state to easily regulate the economy and implement financial policies. This control not only ensures system safety, but also enables timely government intervention in emergencies, safeguarding public interests, especially in worst-case scenarios like a bank's bankruptcy or merger. However, this policy has also led many banks and borrowers to recklessly invest in high-risk projects, believing the government will bail them out. They have flocked to buy long-term Chinese government bonds since January, considering these assets a safe haven amid the stock market and real estate downturn. This has pushed Chinese government bond yields to the lowest levels in decades, increasing the liquidity burden on China's 5 largest commercial banks. If such events continue for an extended period, China's financial rescue system could also become overloaded and stagnant. If this happens, it will destabilize the entire financial sector and lead to societal instability. The People's Bank of China also noted that this incident results from a trend of regional banks shifting to buying long-term government bonds, which are highly susceptible to yield fluctuations. The first bad sign was the drop in the 30-year Chinese government bond yield, inversely proportional to price, to to around 2.5% last week, the lowest level in 2 decades. The 10-year Chinese government bond yield also hit a record low of 2.2% in March. Within just over a month, small banks rushed to buy government bonds worth a total of $400 billion, while large Chinese banks sold 220 billion yuan worth of bonds during the same period. When bond prices plummet suddenly, small banks will start to struggle to maintain their capital and liquidity, leading to the collapse of several financial institutions. Moreover, the Chinese government is also carrying out media campaigns to restore public confidence in the national financial system. This crisis is not only a painful lesson for China's banking industry, but also poses many challenges for the future of China's economy. Is the cause from the US? According to some economic experts, this banking crisis is influenced by the escalating US-China trade tensions. Recently, on July 6th, the US began imposing increased tariffs on Chinese imports, with rates up to 25%, including computer chips, medical products, steel, aluminum, and electric cars, with tariffs tripling to over 100%. The simultaneous declaration of bankruptcy by 40 banks is an unprecedented number since the savings and loan crisis of the 1980s and 1990s. This is believed to be influenced by US-China trade tensions, along with the US ally EU. Historically, relations between the US, EU, and China have been at a crossroads, and now the EU seems to be leaning towards the US. Recently, Europe decided to increase tariffs on Chinese imports to the EU, especially on electric cars. The 3 largest domestic electric car companies in China, including BYD, Geely, and SAIC, will be subject to tariffs of 17.4%, 20%, and 38.1%, respectively, much higher than the previous 10% rate. According to Reuters' calculations on 2023 EU trade data, these tariffs will cost Chinese car manufacturers billions of euros in additional costs amid slowing demand and falling domestic prices. This will significantly affect China's economy and finances. This incident is evidence that the trade war not only causes disruptions in trade, but also weakens China's economy, leading to an increase in bad debts in the banking system. The slowdown in economic growth has directly impacted the debt repayment ability of many businesses, especially those operating in the export sector, making it difficult for them to maintain operations. The imposition of tariffs on Chinese goods by the US has caused many businesses to lose their market, while also reducing revenue and profits. This creates a vicious cycle. Declining revenue leads to inability to repay debts, thereby increasing bad debt ratios in banks. Moreover, the financial condition of banks is severely affected by competitive pressure from foreign financial institutions, making it even harder for them to attract customers and maintain profitability.